Lido, the LDO token, is currently up by 50% in the last 7 days. And why is that? I don't think it's because of technical analysis, right? I do make a lot of technical analysis. I like to do backtests and all of that. But the drivers for Lido, they are different. The drivers for Lido are fundamental. So you want to look at the fundamental basics of all of this, and that's the ETH merge. Because what is Lido? Lido is a staking mechanism for ETH 2.0. So what you can do is you can lock up your traditional Ethereum, you can lock it up in the Lido protocol, and then you gain rewards, right? You gain the staking rewards of Ethereum. But you can't withdraw your Ethereum actually until the merge has happened and until all of this Ethereum gets released again. Now, why do people do this via Lido and not directly via the ETH contract? That's because Lido removes the minimum requirement of 32 ETH that you usually would have to deposit in order to gain this reward. Right, so with Lido you can do this just with any kind of amount of ETH, and that's why it's so popular. More than 5 billion worth of ETH are currently staked with Lido. So why is the price going up that much? What's the driver behind this? It is the movement around the merge, right? The developments around the merge. And recently we had the shadow fork number 9 that was tested and that all went green. Now, when I looked into the details of this, I was actually a little bit, maybe shocked is a bit too much of a word, but I was definitely surprised looking at what's going on there. Because with ETH 2.0, we will still have the problem of MEV, or minor extractable value, or maximum extractable value. And I made a poll on this channel, and most people don't actually know what this is. And I also kind of stumbled upon all of this. And so I want to quickly tell you my little story of how I came to this, what this actually is, and why you should be aware of all of this. So I was maybe a few months back writing a trading bot that tried to exploit some inefficiencies in rebase token projects. So you had things like Olympus DAO, right, that would promise like really high APYs, and they would pay like tens of thousands of APYs every year. And the way this was done is you would get new tokens every 8 hours. So every 8 hours there was a rebase happening, you would get more tokens. And so it was around 1.5% or so that you got every 8 hours. So this was not a constant increase. It was kind of like a step function every 8 hours. So you could actually take advantage of that by quickly buying the token before the rebase, wait for the rebase to happen, and then quickly afterwards selling the token. So you just held the token for a few seconds, and that's basically in the end how you could still gain all of this appreciation without having the risk of the depreciating price, because it would just hold the token for such a short period of time, the price wouldn't collapse in that time. So I wrote a little trading bot around this, and it was semi-successful for a while. But then what I found interesting is I was a bit inefficient. I did a few mistakes there. So what I found out is I was a bit lazy in calculating the slippage. So slippage is how much price movement you accept when making a trade, right? So when you trade, say $1,000, how much are you minimum okay with accepting to get back? So let's say you have a slippage of 1%, then it would be okay when you have $1,000 that you swap to only get back $990, right? Because of the price fluctuations that might run against you in the meantime of submitting the trade to actually get the money back. So that's a slippage. And sometimes the price of these Olympus DAO forks, or of the project itself, it was so high, the movements were so high that you had to set the slippage relatively high in order not to have failed transactions. So in my bot, I set the slippage relatively high. And what I then noticed is that pretty much I always got the worst price of what kind of slippage I set. So if I said 5% of slippage, I would always get 5% worse of a price. If I said 10% slippage, I always would get 10% worse of a price. So for some reason, the price always moved exactly against me, no matter what slippage I set. And so that was surprising. And so I then looked into the order history, like, right, what kind of transactions had actually been transmitted, right, before and after me and all of this. And then I figured out I was a victim of something called sandwich trading. So somebody extracted value from me. That's what MEV is, minor extractable value or maximum extractable value. It is how much can people front run you. So a lot of terms here, but let me try to explain this, right? You submit this trade, you say I'm okay to only get back 90% because of those random fluctuations. Then what happens is those miners, they look at your submitted transaction, and because the transactions, they get processed in blocks, so in bunches, right? They very quickly submit a transaction after you, saying I submitted with higher gas. Okay, they are willing to spend more fees on the transaction than you, so they will be preferred in the block. They will be executed before you. So what they can do is they can buy the token before you do, and then they can sell it to you for this higher price because you take this 10% slippage. And then once you bought the Ethereum from them, or the Olympus DAO token, whatever it is, then they directly sell it afterwards. So you get sandwiched in between. They front run you. They buy it just before you, just to sell it to you to a higher price, to then just dump it again. So that's the problem. That's front running. It's illegal in the stock market. Practically it's still done all the time from these high frequency traders. With crypto, it's the most normal thing in the world. It's even being tested for the rollout of ETH 2.0, and that is what this shadow fork was all about. This shadow fork number 9 is to check out an algorithm for miner extractable value. So can the miners still front run you when you execute trades? And I found this super surprising. Like, why aren't the people trying to solve the problem around this, right? Why are they basically accepting this as a normal thing? As in, we can't really solve this problem. Let's just try to make this as fair as possible, so that maybe that the front running then becomes kind of like an open market, like people bid each other up of how much people can front run. So there's also all kinds of other things going on there. So there's even a market for this now. So yeah, just wanted to share this. This is minor extractable value. That's what they're testing. This was all green. This is going to be part also of ETH 2.0. You will be front run. So the way to kind of protect against this is to make sure to always get just the minimum slippage in there that's justified given the gas fees that you pay. So make sure you don't make the mistake that I did to set too much of a slippage and get sandwich traded. But what I found most important around all of this is, besides the Lido improvement, right, the Lido price and the merge and all of this, the most important thing around this is, I think, the impact on Ethereum itself. Because we've already seen how Ethereum underperformed Bitcoin in this year. And this actually happened while all of this lockup of Ethereum happened, right? So actually less and less of Ethereum is currently floating around, but still Ethereum underperformed Bitcoin. I find this fascinating. If you look at the numbers, it's roughly 10%. It's roughly 10% of Ethereum that's currently being locked up in this contract that's not floating around anymore. That should actually mean that Ethereum would appreciate versus Bitcoin, but it doesn't. So instead, it depreciated around 30% in this year. Now, once the Ethereum gets opened up again, right, gets unlocked with the merge, then more Ethereum will hit the market again, which could potentially be sold off. Maybe some people want to really sell it off now, right? There were also forced liquidations, people that had their money illiquid, centralized exchanges that went bankrupt. So we had all of these things. They might have to then sell the Ethereum in order to give money to their creditors. So I think once Ethereum gets unlocked with the merge, at least parts of that ETH will hit the market, parts of that ETH will depress the price. So on a fundamental way, given that we already see ETH underperforming Bitcoin with all of this additional ETH being locked up, and then even more ETH being unlocked after the merge, I think being heavy on ETH versus Bitcoin is probably a mistake. I think it's more likely that Bitcoin is going to outperform ETH, especially in the current bearish environment, especially with all these tokenomics, the additional supply hitting. So I would be cautious with Ethereum right now. Of course, nobody can read the future, but that's currently how I do it. I rather dollar cost average into Bitcoin right now than into Ethereum. I'm somewhat bearish on Ethereum, even though the merge might happen. If it does happen successfully, it's currently planned around middle of September, then this might not be only positive for Ethereum, right? New supply will hit, and so it might actually depress the token price, at least in the short term. So that's my thoughts on all of this. Should we buy now, LDO or not? Up to speculation, right? There has been a lot of postponements of the release to proof of stake. It's a big question. I personally, I don't dabble now into those somewhat risky altcoins, right? There is a lot of price manipulation happening. Whales are trying to liquidate people that are in leverage in order to just take their money. So be careful out there. Don't dabble too much in alts. Be safe. And if you are still getting additional exposure to crypto, then I personally think it's better to currently rather do this in Bitcoin than in Ethereum or in altcoins. Hope you found this video useful. There is another similar discussion around the bear market over here. Hope you're gonna watch that video as well. And thanks for watching this one. Bye bye.